Everyone's celebrating that you don't need a 620 credit score anymore to buy a home. But I'm going to tell you something that nobody else is saying. This might actually make it harder for you to get approved. Now, I know this sounds crazy, but stick with me because by the end of this video, you're going to understand exactly why. Hi, I'm John Wells, a mortgage lender and branch manager with a decade of experience in the lending space. I've helped thousands of people just like you achieve their goals while being budget and wealth conscious. So if that sounds good to you, let's get into the video. Now, Fannie Mae just dropped a bombshell. They removed the 620 minimum credit score requirement for conventional loans, and the internet exploded. Everyone's saying that this is a game changer and that it's gonna open doors for millions of people. And you know what? They're partially right, but there's a whole other side of the story that nobody's talking about. And that's what we're diving into today. Because here's the truth. I've been doing this for over 10 years. I've seen policy changes come and go. And every single time there's a big announcement like this, there are winners and there are losers. And the difference between which one you are comes down to one thing: understanding what's really happening behind the scenes. So in this video, I'm gonna break down exactly what this change means, who it actually helps, and more importantly, who it might hurt. I'm going to show you the hidden traps that could cost you your approval even with this new rule. And I'm going to give you the exact strategy you need to use this change to your advantage instead of letting it work against you. And if you're serious about qualifying for a home, I want you to fill out this free questionnaire to see just how home ready you are. The link is in the description below. It takes 2 minutes and it gives you a clear picture of where you stand right now. All right, so let's start with what actually changed. Fannie Mae announced they're removing the 620 credit score floor. That means technically you could get a conventional loan with a 580 or even a 590 credit score, or even lower in some cases. And on the surface, that sounds incredible, right? Because for years, that 620 number has been this brick wall that's kept so many people out of homeownership. But here's where it gets interesting. Just because Fannie Mae removed the requirement doesn't mean lenders have to follow suit. And that's the first thing that nobody's telling you. See, Fannie Mae sets the rules on what they'll buy, but individual lenders, banks, credit unions, and mortgage companies, they set their own rules on top of that. They're called overlays, and a lot of lenders are going to keep that 620 requirement in place anyways. So if you walk into the bank thinking you're going to get approved with a 595 credit score, you might get denied. Not because you don't qualify under Fannie Mae rules, but because that specific lender has their own internal policy. They can just say you don't meet their lending criteria and send you on your way. Now you might be thinking, okay, so I'll just need to find a lender who follows Fannie Mae rules exactly. And yes, that's part of the strategy, but there's something else going on here that's way more important. And it has to do with how your credit score actually works in the approval process. Let me tell you about a client that I had last year. We'll call her Maria. Maria had a 605 credit score. She'd been working on it for months, paid off collections, got caught up on old bills, did everything right, but she was still below that 620 line. So when this announcement came out, she called me immediately. She was so excited because she thought this was her moment. But here's what I had to explain to her, and this is what you need to understand too. Your credit score is just one piece of the puzzle. It's an important piece, sure, but it's not the only thing lenders look at. In fact, with this new change, lenders are going to dig way deeper into other parts of your financial life. And for a lot of people, that's where things are going to really fall apart. See, Fannie Mae said they're factoring in things like rent payments, utilities, and other non-traditional data. That sounds great if you've been paying your rent on time every month, but on the flip side, if you've had inconsistent rent payments, or if you've overdrafted on your bank account, if you've had NSF fees, all of that is now under the microscope, and that's the trap. Before this change, if you had a 625 credit score, lenders would look at your score, check your income, verify your employment, and you probably get your approval. It was pretty straightforward, but now they're going to look at everything, your entire behavioral history. And that means more ways to get denied. I want to pause here and make sure this is landing, because this is the core of what I'm trying to tell you. This change isn't necessarily making it easier to buy a home. It's shifting what lenders care about. And if you don't understand that shift, you're going to walk into this process blind, and that's dangerous. So let me ask you something. Have you paid your rent on time? Do you have overdraft fees on your bank statements? Have you been floating payments between paychecks? Because if the answer to any of those questions is yes, you need to fix that before you apply, not after. Now let's talk about the people this change actually helps, because there is a group of borrowers who are going to benefit massively from this. And if you fall into this category, this could be the opportunity you've been waiting for. The people this helps most, the folks who've been doing everything right financially, but just haven't built traditional credit history. Maybe you're young and you never had a credit card. Maybe you're an immigrant who just moved to the US and hasn't had time to build credit. Maybe you went through a financial crisis years ago, rebuilt your life, but your score is still recovering. If that's you and you've been paying your rent on time, keeping your bank accounts in good standing, and paying your utilities without missing payments, this is your moment. Because now lenders can see that you're financially responsible, even if your credit score doesn't reflect it yet. But here's what you have to do. You have to document everything, and I mean everything. Get proof of your rent payments going back at least 12 months. Pull your bank statements and make sure they're clean. Get letters from utility companies showing your payment history. Build a file that shows lenders you're a safe bet. And if you want help figuring out exactly what documents you need, I've got a free download for you. It's a home readiness checklist that walks you through every single document lenders are going to ask for. Grab that in the description below. It's going to save you so much time and stress. Now, here's the subplot I want you to keep in mind throughout this whole process. This isn't just about getting approved for a loan, it's about building wealth. And that's where a lot of people get it wrong. They think the goal is just to get into a house, any loan, just get approved and figure it out later. But that's how people end up in bad situations. That's how people get underwater on their mortgages. That's how people lose their homes, because they're focused on the approval instead of the strategy. And if you're watching this video, I'm guessing you're smarter than that. I'm guessing you want to do this the right way. So let's talk about the right way. If you're somebody with a credit score below 620, and this change opens the door for you, the first question you need to ask yourself is, should I walk through that door right now? Or should I wait 6 months, build my credit up to a 640, and get better terms? Because here's the reality. Even if you get approved with a 590 credit score, your interest rate is going to be higher. Your down payment requirement might be higher. Your monthly payment is going to be higher. And over the life of a 30-year loan, that could cost you $50,000 or more. So is it worth it? Sometimes yes, and sometimes no. It really depends on your unique situation. If home prices are rising fast in your area, and waiting 6 months means getting priced out of the market, then maybe you pull the trigger now. But if the market's stable and you can afford to wait, it might make sense to build your score first and save yourself a fortune in interest. And this is where having a lender who actually cares about your financial future makes all the difference. Because a lot of lenders just want to close loans. They don't care if you're getting the best deal. They don't care if you're setting yourself up for success. They just want their commission. But if you're working with somebody who's thinking long-term, someone who's looking at your wealth building strategy, they're going to tell you the truth, even if it means they don't get paid right away. And that's the kind of lender you need. Now, let's get into the weeds a little bit, because there's some technical stuff here that you need to understand. Fannie Mae said they're going to use rental payment data to assess credit worthiness. But here's the thing, not all rental payment data is created equal. If you're paying rent to a property management company that reports to the credit bureaus, then great. That's super easy for us to verify. But if you're paying rent to a landlord who doesn't report anything, it gets a lot trickier. You're gonna need to show bank statements showing the payments coming out every month. And those payments need to be consistent. Same amount, same time, every single month. If there's a random month where you paid late or you paid less, lenders are gonna ask a lot of questions. Same thing with utilities. If you're including utility payments as part of your credit profile, those need to be in your name, not your roommate's name, not your partner's name, yours. And they need to show a history of on-time payments. 1 or 2 late payments probably won't kill you, but if there's a pattern, that's going to be a red flag. And here's something else that's going to matter more now than it did before. Cash flow. Lenders are going to look at your bank statements and track your cash flow. Are you living paycheck to paycheck? Are you overdrafting regularly? Are you making deposits that don't match your income? All of that matters now more than ever. So if you've been relying on side income that's not reported, or if you've been getting financial help from family members, you need to clean that up before you apply. Because anything that looks inconsistent or unexplainable is going to raise questions. Alright, so let's recap what we've covered so far. Fannie Mae removed the 620 credit score requirement. That's a big deal, but it doesn't mean that everyone under 620 is going to get approved. Individual lenders still have their own rules, and more importantly, lenders are now looking at way more than just your credit score. They're looking at rent payments, utility payments, bank statements, cash flow, overdraft history, everything. And that means you need to have your financial life in order before you apply, not just your credit score. everything. So here's my question for you. Are you actually ready? Do you have 12 months of clean rent payments? Do your bank statements look good? Have you been managing your money responsibly? Drop a comment below and tell me where you're at in this process, because I read every single comment and I love hearing from you. Now, before we wrap up, I want to answer a question that I got in my comments of my last video. Somebody asked, John, if I have a 610 credit score and I get approved under these new rules, would I be able to refinance later to get a better rate? And the answer is yes, absolutely. In fact, that might be part of your strategy. If you're in a situation where you need to buy now, you can get approved with a lower credit score and a higher rate, and then refinance in a year or two once your credit improves. You'll pay more in interest in the short term, but if it gets you into the house and starts building equity, it might be worth it. But here's the key. You have to have a plan. You can't just assume your credit score is going to magically improve. You have to actively work on it. Pay down your debt, make on-time payments, and keep your credit utilization low. And then when you're ready, you can refinance into better loan terms. So to sum it all up, this change from Fannie Mae is a shift. It's not a solution. And it opens the doors for some people, but it also creates new challenges. If you want to take advantage of it, you need to understand the full picture. You need to have your finances in order, and you need to work with a lender who's going to guide you through this the right way. So if you made it all the way to the end and are considering a new purchase or refinance in the next 6 to 12 months, use the link below to schedule a free consultation with me. I'd be happy to help you gain insights on how to structure your new mortgage in a way that benefits you, not the bank. And if you found this video helpful and you want more content like this, hit that subscribe button, because I'm going to be continuing to break down exactly what these policy changes affect and what you need to do to stay ahead. And listen, if you liked this video, you'll love the next one. I'll see you there.